This video takes a quick look at how tax shelters work. A tax shelter is basically a bank account that is registered and therefore not taxed as it earns interest and grows. The video focuses on retirement savings in a registered account since most people use them for this purpose. Let's consider the average worker who wants to save some money in a regular bank account. It's kind of like trying to save your money in a bag that has a big hole in the bottom. Some of it won't be able to be saved because of the income taxes. At the end of the first year, the worker did not set aside any savings for their retirement and receives a small refund because they ended up paying too much income tax. After the second year, the income taxes are again diverted from the worker's savings account since they did not use the retirement deduction. If they did, then that would have significantly reduced their income tax, which would have resulted in a large refund. By the third year, it is clearly having a detrimental effect on the savings. By not putting aside that money in a registered account, they ended up walking away from the money which they could have received from the refund. Fast forward to the 30th year, this worker is considering retiring, but since they never chose to use any income tax deductions for retirement, they have limited options because of all the taxes they paid even though it could have been legitimately avoided. Let's travel back in time and start over. This time we'll see how a registered retirement account can divert some of the income taxes back to the worker so that they can better save for retirement. The tax shelter lowers your taxes and protects your money from being taxed as it grows. This is done by first saving money in a registered bank account and then by reducing the taxable income on your tax return by the amount that was saved. Depending on your income, some tax still might end up going to the government, but because of the registered savings account, some of that tax goes back to the worker, which is shown here as a tree. The interest is represented by apples. After the second year, the year 1 savings have 2 years of interest, and the year 2 savings have 1 year's worth of interest. This compounding effect will continue as long as none of the savings or interest is ever removed from the registered account. After the third year, 3 years of interest have accumulated on the year 1 savings. The year 2 savings have accumulated 2 years worth of interest, and the year 3 savings have 1 year's worth of interest. As we fast forward to the 30th year, the compounding effect of all those tax savings has created a large retirement savings fund. At this point, the worker can consider retiring and using these savings to help fund their retirement. Please note that if they withdraw enough to push their income into a taxable bracket, then they will owe income taxes once again. This is because income taxes take into consideration any funds that come out of the registered account, as well as any other income such as a pension. So in short, the benefit of this tax shelter is that the income taxes are brought down during every year that money was set aside for retirement, with the added bonus that the money was able to grow over the years leading up to retirement, without triggering any income taxes on the interest or dividends that were earned from those savings.